So at the simplest form, and most people don't know this, what are stocks? Well, if you buy a stock, what you are an owner of a particular company. So if you buy stock in, say, Apple, well, you are a part owner of Apple upon your ownership of that stock. So they are pieces of fractional ownership of companies. And at any given point in time, you are not owed anything by the company beyond the market value of that particular amount of shares or share that you purchase. So that proportional ownership, that is how much you are owed by the company at any given point in time. And so what this does is this entitles you to a portion of the firm's assets and profits. So the value of a firm is going to be determined by both assets and future cash flows and future profits. And so you as an owner are entitled to a piece of those assets and profits. And so you are going to make money. The value of your shares are going to increase when the value of the firm's assets go up and when the profits increase. And then naturally, if the value of the assets decreases or the profits decrease, then you will see a proportional decline in the ownership in the shares that you own of the company. And from those profits, you may actually get a direct distribution. You may get a direct amount of money from the profits of the firm in a way that is called dividends. Dividends are direct payments from the firm to the investors. So as an owner, you may get some amount from the firm directly in cash. Sometimes they pay dividends in stock, and they may actually do what's called share buybacks to where the value of your shares increase because they buy some shares off of the market. So the less shares out there, the higher the value of one share is. And so those are ways that you can get increases in your own capital from the company making distributions of their funds directly or indirectly in the case of share repurchases. Now, pretty obviously, what this is going to mean is individuals who have the highest proportion of ownership of shares are going to have the most influence on the firms. And in many cases, that is the officers of the firm. So the CEOs, the CFOs, those who actually are running the company day to day, and or those who founded the company. So like Bill Gates still holds a large amount of Microsoft stock because he was the founder of Microsoft. And so you see how those who hold the most of the firm, they can have a very heavy influence because as an owner of anything, like as an owner of a home, you make the decisions about what you do to your home, or as the owner of a car, you make the decision of the things that you do to your car. And the same works with a company. It's just split up into a bunch of different pieces. And the reason that some firms have stock, shares outstanding, and the reason that some firms do not is because it is a particular way that firms raise money to fund their operations. And so what do I mean by this? Well, if I am a particular firm and I want to raise money to do something, well, the way that I can do that is threefold. I can either take money that I already have, so I can take from what they call retained earnings, which is just old profits that I have laying around. So I can take from that and I can pay for whatever it may be. I can raise debt, so I can get a loan or issue bonds, which we're going to talk about tomorrow, in order to fund those operations. Or I can sell shares of stock. And what that does is it says, okay, let's say just one individual owns the entire company. Well, if they decide that they want to fund operations by selling shares of stock, then they are selling their ownership in the firm for some value, for some amount. And so when the firm receives that money, they give up ownership in direct proportion to the amount of money that they received. And so you see that firms are selling shares of stock not just so people can own a piece of the firm. They do so they can receive the benefits of having outside ownership and the benefits of being able to raise funds from other places. And when you are buying shares of stock, you're typically not doing it I would say none of us are doing it directly from the company. What happens is the company sells it to a bunch of large investors and large entities and banks and investment banks and all of these mutual fund companies and things like that, all of these entities. And those entities then sell them to the public via what they call the secondary market. The primary market is when the firm is selling it to investors. And the secondary market is when investors are trading the shares back and forth. And that is where we are operating. We're not giving the firm money directly. The firm is receiving funds from those entities that I just spoke of. And there are two typical types of shares or stock that you can purchase. One, and the most common, is called common stock. Common shares entitle the owners, entitle the individuals who buy the shares to a piece of the profits and the assets of the firm proportional to the amount of the firm that they own. And this is just what we talked about a moment ago. These individuals can also receive dividends from the firm if the firm so chooses to pay them. And these are just the type of shareholders that most of us are. When most of us talk about buying shares of stock in a company, we are common shareholders. We are common stockholders. And so that's the most common type. Then there's also preferred shares, preferred stock. And preferred stock, they don't have any voting rights. So the common shares have voting rights where they can actually vote on what happens within the company and the operations of the company. The preferred shareholders do not have voting rights, but they have first dibs when it comes to the earnings and the dividends that the company pays out. They are going to receive dividends before common shareholders, and they're going to receive any kind of payout if there is a bankruptcy or anything like that before a common shareholder will. And these particular shares are not known for their increase in value, but for the dividends that they receive. They typically receive higher percentage dividends. And the reason that this is the case is because even though the firm is giving up some type of ownership, that is not a shareholder that they have to necessarily answer to when it comes to their ability to vote and their ability to make decisions. So since they don't give them that right to vote, they give them this other incentive in the way of dividends. And so the thought about preferred stock is really kind of an in-between between common shares and debt. And like I said, we'll talk about debt and bonds tomorrow. But it's just a good idea to know what preferred shares are. That way, when we may bring it up later in the future or something like that, you'll understand them. But our focus is going to be on common shares and common shareholders because that's what most individuals are.